Hello and welcome to Portfolio Matters, week 60. And it has been a very dramatic week in the markets with commodities in particular moving all over the place, but generally up in response to the Russian invasion of Ukraine. Now, there's a lot going on, but before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith.
Okay, well, before we get going, next week, pub night. We can all drown our sorrows and discuss about our latest losses. On Wednesday night, High Holborn, 6:30, City of York pub. Okay, well, the news is dominated by the war in Ukraine, which drags on, and we're now 9 days in, and we will go into Russian progress, which is not that much, and this threatens to be a long war, and it has caused a spike in oil prices, wheat prices, palladium prices, and commodities have had their biggest spike in, I think, 30 years. In response to the spike in the oil price, the IEA has organized a release of 60 million barrels of oil, but that will only dampen oil prices briefly.
I also think, Keith, on that subject, that the whole purpose of a strategic reserve is that it's a reserve in times of use in times of crisis, not to manage the price of oil in the market. And I think it's a misuse of a strategic reserve.
So the Ukraine situation drags on. Actually, we're going to go into Russian progress. Now, on another matters, in Britain, the first electricity bills, revised electricity and gas bills, are hitting consumers' doorsteps. Now, these will not come into effect until the 6th of April. But this is a very vivid example of how increased oil and gas prices are going to impact energy bills and consumer demand. So this is my own bill. So I was with Bulb, who British viewers will be aware has gone bust and has been taken over by the government. And my bill will rise by 88% on the 6th of April. Now, we are meant to have a private market in energy, and so I should be able to switch. But I have checked out all the major surviving suppliers, and none of them are accepting new customers. So that is actually going to be quite a large hit to disposable income, particularly for people lower down the financial spectrum. Richard, what's your bill been like?
Well, to be honest, Keith, I haven't looked, but even I'm surprised by your 88% increase there. But I haven't gone into it in the level of detail that you have. Of course, there's two things. One, it's inevitable. Secondly, there is an inevitability of further very large increases.
Yeah.
And is hugely unaffordable by a lot of people. And it is going to be very inflationary. And I think, as you have said on a number of occasions over recent weeks, that there is no time where you get an oil price spike where you don't then get a subsequent recession.
On that point, Richard, it is inflationary short term, but medium term, it's hugely deflationary because you're sucking demand out of the economy. And as you say, when you have an oil price spike, you tend to have a recession in short order. So actually this week, I have been very worried about the energy price spike, and we will go into that.
I think it's fair to say that a lot of energy consumption is non-discretionary. So it simply subtracts from the available amount of money for purchasing other products and services.
And so this is the weekly change in the commodity index, and you'll see it's had its biggest spike since the 1970s. So what's that? The best part of 50 years.
Yeah. And I noticed that the price of wheat today is up 17% at the moment.
Yeah. We've got a special section on the wheat market coming up. So as a result, extreme fear is stalking the market, and the equity markets are down again this morning, which is Friday morning. Okay, now we're going to go through some economic data, but I should strongly caveat all this data because it's essentially out of date. It's all more than 9 days old, i.e. prior to the Russian invasion. So as of February, UK consumer confidence was already declining and missing expectations, and that is going to get a lot worse. But consumer lending to consumers in the UK had exceeded expectations, and you have to wonder whether consumers are already stressed and starting to borrow, or the alternative explanation would be that they're confident and they're starting to spend on discretionary items again. We'll have to see how that number evolves. The other numbers I'd like to cover are the EU inflation rate, which massively beat expectations. So expectations were for 5.2%, slightly up from January. It came in at 5.8, massively above expectations. The core inflation rate also beat expectations, and those numbers are only going to get worse. And the final number I want to cover this week is US home sales, which shrank by 9.5% year on year, well below expectations. Expectations were for them to shrink only by 5.1%. So the high house prices in the US are causing a reduction in demand. We'll go through some charts. Richard.
A few weeks ago, we were in an environment where everybody was thinking interest rates were going to increase steadily over the next couple of years, a quarter or half a point every quarter or every half year. We're now in an environment where that has basically been dismantled, and I suspect that the central banks are even now thinking of what more QE do they need to do in order to maintain a semblance of economic growth, given the huge pressure that fuel prices are going to put on the economies. So basically what we're seeing is a complete reversal in 1 month of the interest rate expectations.
Yeah, absolutely. And to be clear, the central banks do not need to raise rates now, because the disinflationary effect of higher rates should cool the economy down by itself.
I think there's this economic conditions, isn't there, where are economic conditions tight or loose? And loose is there's lots of central bank money, interest rates are low, oil prices are low.
Yeah.
Financial conditions are tight is the reverse, and we have plenty of central bank money and low interest rates, but my goodness me, oil prices are not low, and Absolutely. They on their own can cause a huge tightening of financial conditions.
Yeah, I really think the only danger that central banks need to be on the lookout for is the start of a wage price spiral. So the high oil price is saying that there's not enough oil to go round. Now, if workers try and compensate for rising inflation by asking for higher wages, then higher wages does not make oil more affordable, because there's still only so much oil. What will happen is you'll just get more inflation. So the central banks need to, if you see wage rises, they need to start thinking about intervening. But in the absence of wage rises, high oil prices should naturally deflate the economy.
UK consumer confidence, I mean, it has turned over, hasn't it? It's rolled over sharply in it's really late 2021. And I remember a few weeks ago, probably saying it's hard to tell whether it's an uptick or not. Well, clearly it was an uptick in quite a vicious downtrend. And it's hard to see that UK consumer confidence is not going to drop further from this point, given the current circumstances in the world. UK mortgage lending, well, it's bang on the trend, on the mean figure for the last 4 years, if you exclude the COVID period. It's obviously a significantly trailing indicator.
Yes.
UK EU Economic Sentiment Index, I suspect that this reading has not yet been affected by the recent events in Ukraine. EU consumer confidence is not looking healthy either, and it is inevitably going to drop from this point. US pending home sales year on year. We know that the US pending homes is US home market appears to be entering a slowdown, and this is confirming it. Initial jobless claims pretty stable. This is a weekly chart, and continuing jobless claims also fairly stable at the moment. So EU carbon prices fall as Italian business lobby Confindustria calls for the suspension of the scheme. So, I mean, clearly this is, and I have to say, those of you who watch know that I have been dabbling in the EU carbon price ETF, and I sold it yesterday because it took a bath, and this was always the risk of it in an environment of rising oil prices. And I think in an environment of naturally rising oil prices, the EU probably would have done nothing about it. I suspect in this environment, they will not want to damage EU industrial activity and competitiveness by insisting that this scheme remains in place, and I'm sure it will be suspended.
Well, also, Richard, if the aim of the carbon pricing scheme is to raise the cost of hydrocarbons and disincentivize people from using them, well, the oil and gas prices are doing it on their own. They don't need any help from the EU.
Yeah. All of this is going to result in a massive rotation into clean energy.
Yes. Yeah, but that takes time. Okay, I would quickly like to do a review of the war in Ukraine because essentially how long this lasts and how long sanctions remain in place is going to have a huge effect on the financial landscape and the investment world. Okay, so this is from The Economist, and they are saying actually the gap between Ukrainian military spending and Russian is not as large as the nominal figures would suggest. Once you adjust for purchasing power parity, Ukraine does around 20% of the spending that Russia does. If you look at the nominal figures, it looks much, much bigger than that. So the nominal figure is in gray here and in gray in Ukraine. It looks absolutely tiny, but when you adjust, the figures come close together now. And obviously, Russia doesn't have the whole of its military in Ukraine, whereas Ukraine does. So when it comes to troops on the ground, Russian forces are currently outnumbered by Ukrainians within Ukraine, although Russia has much more hardware. When it comes to just military personnel, including militia, the Russians are heavily outnumbered.
I was listening to an interview on the PM yesterday, the Radio 4 news program, of an unnamed person who was speaking from Russia, who basically said that they thought the authorities were preparing for conscription of Russian males in order to bolster the numbers of troops that they could put on the ground. Yeah.
Now, this is the latest progress, and you can see they're a long way from taking over Ukraine. They've attempting to encircle it, but not much progress so far. And this is the latest report as of 3 p.m. yesterday. So Kiev is here, approaching from the north, but they're a long way from encircling it. And as everyone will know, they've met stiff resistance, and Ukrainian army has a strong will to fight.
I think this is the point we talked about last week, where there's a big asymmetry with modern weapon systems. So the Javelin anti-tank missile, that actually could be used for any anti-vehicle missile, really, will destroy a tank, and will destroy a $20 million tank.
Yeah,
and it costs, I don't know how much it costs, $10,000, whatever. So there's a huge economic and hardware asymmetry in these things, and I don't think the Russian forces have counted for that. And also, I suspect, this is I hate to depersonalize this actually, but the tank is not necessarily the super weapon for taking control of ground that it once was.
Yeah, I completely agree. The other thing is that Russia has suffered very serious logistical problems. Now, this is the problem of taking over any large territory. You overrun your supply lines. And there have been lots of pictures on social media of abandoned Russian military vehicles, abandoned just because they've run out of fuel. And when we talk about logistical issues, this is this convoy which is approaching Kiev and has been stuck for a couple of days now. And you'll see the roads are just packed. They can't get anywhere. You've got this 60-kilometer convoy, but as long as the Ukrainians keep the front pinned down, the rest of it is just static.
Yeah.
And I'm just going to play you a short video. Okay, so this is Russian military helicopters attacking Hochmel Air Base just outside Kiev. And what I want you to concentrate on is looking at the helicopters. They're flying steadily in formation. They're not zigzagging. They're not hugging the ground. They're not firing off chaff or flares to distract surface-to-air missiles. They look like they're on military parade. So the Russian forces don't seem to be, frankly, very professional. Now, they will be learning very quickly, but it seems like they thought that taking over Ukraine would be a walkover, and it's not proving to be. The other thing is we, the West, are supplying Ukraine with, frankly, absolutely enormous quantities of armaments. Germany is going to supply 1,000 anti-tank weapons and 500 Stinger shoulder-launched surface-to-air missiles. Sweden is going to provide 5,000 anti-tank rockets. You heard that correctly. And Turkey is supplying more drones. In fact, Turkey has closed the Dardanelles to Russian warships. So
they've closed the Dardanelles to all warships in spirit of neutrality. So and I think the other thing, Putin or Lavrov, I'm not sure which, has come out. Basically, they said any country that supplies weapons to the Ukraine is at war with Russia, and so Russia is constantly upping the ante on this. And clearly there's a war of rhetoric going on, but I think the difficulty is we don't know what Russia's bottom line is or what Putin's bottom line is.
Yeah. Well, the bottom line is that on the military aid, Ukrainians have the resources to fight for as long as they like. And the whole Russian military plan is to attack from multiple directions, so they lack concentration of force. And so they therefore risk defeat in detail. So
I think I am not a military strategist, but it would appear that their grave weakness is that whilst they're able to bombard cities from afar, they can't actually take them. And because they don't have the resources to do that. And in a sense, once they start reducing Ukrainian cities to rubble, the defenders have nothing else to lose. There's no negotiation, there's no bargaining chip, because the defenders are forced into a position of having no option but to continue fighting. And I think it's very, very sad, but I think that Russia has entered a war that it cannot win, but it is in danger of dragging the whole world down with it.
Yeah, I think he can't win. You know, as we discussed in January on the weekly, I didn't think Russia would invade, because you can take as much open countryside as you like, but the moment you get into an urban environment, you face snipers in every building. You just can't take and hold cities.
And also, you look at that map, and the border with Poland is long, and vast quantities of military material can come in through there. Russia has no control over the movement of that material into the north and east of the country, and they can't fly their airplanes because the countryside is rife with anti-aircraft shoulder launched Stinger missiles. So they can't really maintain air superiority over the supply routes in from Poland.
And I think these pictures of Putin and his cabinet are interesting, because one of the hopes for the West is that Putin would be deposed. But I really question that. Everyone within his circle has essentially tied their flag to his. They're going to go down with him. So I think any coup would have to come out from outside the inner circle, from the army. And actually, when Richard talks about conscription is a big moment, because if you attempt conscription and you don't have buy-in from the rest of the population, that's a precipitation event. Now, the other thing I'd say is I think that Putin is suffering from the dictator's curse, i.e. he has surrounded himself with yes men who tell him what they want to hear, and he has convinced himself that he'd be able to walk into Ukraine with an enormously strong army, but nobody's told him that his army is much less effective in real life than it is on paper, or that Ukraine really will do absolutely anything to keep him out. So I question whether he actually knows how badly the campaign is going. I wonder whether everyone is telling him it's going very well. So the conclusion, my conclusions from all that is this is not going to be a short war. That in order to win it, Putin is going to have to escalate. And the bombing will get worse, the humanitarian tragedy will get worse. And for us in the investment world, that means expect prolonged disruption to commodity supply chains, in particular palladium, wheat, oil and gas.
I would also add in aluminium and nickel, Keith.
Right. Thank you, Richard. And obviously Russian assets are uninvestable, but also there is a hidden financial shock going on now. Anyone who owned Russian financial assets has taken an absolutely enormous hit. And we know a lot of European banks were exposed to Russia, and we don't know what their losses are. Then we don't know who was exposed to the European banks.
So an interesting Twitter quote, Keith, from Lynn Alden, which says, the difference between assets that are someone else's liability and assets that are nobody's liability probably got a lot clearer to people in recent weeks. In other words, you may think you own an asset, but if someone else effectively has control over it, you never really own it. You just have to have faith in the system of control. There's a lot of exposure to of the European banking system to the Russian financial market and the Russian banking system. And since one of the goals of the sanctions is effectively to take out the Russian banking system, with the somewhat hypocritical exception of that which is involved in oil and gas export, there will be collateral damage to particularly the European banking system, which will have to be rescued if required. by the ECB.
Yeah, absolutely. But they don't rescue it at par. Okay, so that leads on to, how does this situation end? Well, and thank you to our various members of the Discord channel for discussion on this. So I've envisaged 5 possible scenarios. Number 1, prolonged war. And frankly, that is my default scenario. I think this could drag on, frankly, for years. Now, Russia's plan is to conquer the entire country and install a puppet government, but I can't see how they will achieve that without prolonged urban fighting. So again, that's a long war scenario. The option 3 is a Russian victory in which they carve out the eastern portion of the country as a separate state. But again, I think that takes a long time. And importantly, in the event, if that were to occur, Western sanctions would stay in place for a long time.
And also, I think that the Russians would have to hold it as an enclave at war, because the rest of Ukraine would not accept it. Certainly, with the current state of mind that they're in, and they would simply continue to attack the carved out Russian eastern enclave. So I can't actually see that working either.
The short war scenarios are regime change in Russia, leading to a Russian withdrawal, or an armistice in which Russia withdraws following an agreement from UK not to join NATO. But in that case, in both of those cases, we'd just have to wait and see what happened and wait for changes in the sanctions regime. Now, if we look at option 3, carving out the eastern portion, you can see that that may be part of the Russian plan. Now, on the will they overthrow Putin? Well, I think the analogy here is with Nazi Germany. And arguably, Germany had lost the war by 1943. But what I think is really important is that there were no attempts to replace or overthrow Hitler from within the inner circle. The only attempts were from within the army, and because they had such a good intelligence apparatus, they were mainly closed down. I mean, we think of the Rommel plot, etc. So I think if you're looking for Putin to be replaced, it would have to come from outside the inner circle and from the army, and that would require a lot of stress on the army, I would suspect. So would come after some months of ineffectual fighting.
And the obvious strategy available to Putin is to purge his army, senior officers.
Yeah.
A la Stalin.
So we believe that the default is likely to be a long war. And so what are going to be the implications of that? Well, sanctions are going to remain in place on Russia, and they are very hard sanctions. And there's going to be big disruption to commodity markets. We've seen a big spike in oil and gas prices, and the world runs on energy, and those are inherently deflationary. They suck demand out of the economy. And so the danger is, if oil and gas prices go too high, we have a recession.
The issue of sanctions against Russia, I mean, there are debates. Some people say, well, it's not going to make much difference. China will come to their aid. Others say that it's going to make a huge difference. But one of Putin's exit routes, what he considered to be an exit route, was the support of China. I'm not sure that he has the support of China anymore. And I don't know if you saw yesterday, Keith, but the Asian Investment Bank, that's AIIB, which is effectively a Chinese-controlled investment bank for Asia, is refusing to do business with Russia anymore. And of course, the Chinese don't want a nuclear war.
No.
Nuclear war is to nobody's benefit. The Chinese don't want to get dragged into a nuclear war. And the Chinese have a problem now. Do they dissociate themselves from Russia so they minimize their economic damage? to what extent do they act as a surrogate Europe for Russian oil and gas, where they can pick it up at a bargain price relative to the world oil price. So that's a sort of an outlet for sanctions on Russia to fail or not to be as successful. But the other thing I'm finding particularly striking is, first of all, we learned the lesson of interconnectivity of economies during COVID. And Russia, or Putin, doesn't appear to have learned the lesson, however. So many services to the Russian economy that have been provided by Western countries are stopping dead. And that's not just impounding the oligarchs' assets. It's servicing jet engines, it's payment processing systems. It's things that are essential basically to maintaining the Russian economy in a functional state are being ripped out in short order. I don't know whether the Russian economy can survive that for very long at all. And I don't think the Chinese, even if they were inclined to do so, I don't think they could substitute it. So I do think there's a scenario where the Russian economy collapses very quickly. What that does to the war, I don't know, because Russia has a great deal of military resource, which it can pour into the Ukraine. It can become more and more of a command economy. And whether a collapse of the Russian economy shortens the course of the war or actually makes the course of the war worse, I think is, I can't decide. But I do think the Russian economy may collapse remarkably.
On that front, I also think the Russian military capability is being degraded day by day. And their ability to replace a lot of their lost kit is also going to be very heavily impacted by sanctions.
Yeah, definitely.
So short term, the war will be positive for commodities, but not necessarily commodity equities. Safe haven assets such as gold and index-linked bonds and physical assets, I would assume. Richard, any thoughts?
Yeah, I think you have to differentiate quite carefully between the short and the long term. So yes, short term, there's going to be a huge supply shock for a lot of commodities, and we're seeing the effect of that. Short term, that may positively impact share prices. But in the long term, it pushes us into a recession, which reduces demand. So you get a sort of self-correction. And that clearly is bad for commodity prices for wherever they peak at, and is bad for the equities of commodity producers. So my view is that there is a window in which commodity prices will be very strong, and then most of them will start to fall back, but not all of them. So agricultural commodities, I'm not sure how the world can adjust to losing Ukrainian wheat supplies quickly. Commodities that are required for moving to renewable energy will become in even greater demand than they have been. So I think you then move have to be quite nuanced in which commodities will do well and which won't after we get through this phase, which I don't know how long it will last. So I'm not sure that we can differentiate between long war and short war investment implications, because I think the whole merged too much. But I do think maybe we should talk about precious metals.
Well, we've got a whole section on that later coming up, which we cover it then.
Let's cover that, yeah.
Okay, so let's talk about the Russian economy. So sanctions have been explicitly implemented by central banks of the world, and they have frozen Russian reserves. Now, this chart from the FT shows Russians' foreign exchange reserves and gold assets, and you'll see they hold most of it in euros and dollars. Now, and also they've got some sterling. Now, when Western central banks freeze Russian central banks' assets, essentially Russia loses access to all those reserves. So that is something like 60% of its reserves gone. It's unable to use those to pay for imports.
There's also, it doesn't necessarily not lose its gold reserves, because although it has the gold, it can't exchange them for dollars. So it may be able to exchange them for renminbi, and that again, that's Russia's out. But if China doesn't want to play ball because Putin is too dangerous, then you can't even use gold.
Yeah. So this is the ruble, which has fallen heavily. This is the Russian stock exchange, which has fallen more than half in the last few months. This is the Russian 10-year bond, and you'll see the yield has pretty much doubled. There's going to be a lot of financial stress going through the Russian economy. Anyone with a mortgage is going to be really hurting. This is Russian short-term interest rate. So Russia raised its interest rates 20% on Monday.
Given the circumstances where its central bank reserves have been sanctioned, and nobody who's willing to do business with Russia, I'm not quite sure that raising its interest rates serves any purpose, because the ruble is now a non-exchangeable currency.
Yeah.
So I don't think it works.
Good point. These are Sberbank shares listed in London. They're down an amazing 99.7%. And the concern is, A, that sanctions are going to bankrupt them, but actually the real concern here is just nobody's willing to buy the shares. You can try and sell them, but there are no buyers. These are Evraz shares, which is the Russian steelmaker. Now, I bought them pre-invasion in the belief that Putin wouldn't be so stupid as to invade Ukraine. And then when he did, I promptly sold them. And then for a few hours, I was looking not very clever financially, although I did it on moral grounds. But since then, they've fallen 2/3. So bear in mind, the shares used to be above £6 and are now at 50p. This is Russian gas or exports in dollars. So the gas price in Europe has spiked, and Russia has actually increased its flows to Europe. So every day we are buying lots of Russian gas and funding their war in Ukraine. And
so I noticed that Germany is building 2 new LNG terminals, which presumably is going to be building at breakneck speed. And I think that by next winter, Europe will actually wean itself off Russian natural gas to a very, very great extent, and will never go back to it. But clearly, in the interim, we have put ourselves in an extraordinarily vulnerable situation.
Yeah. And this is what Germany imports from Russia and Ukraine. You see, they don't just import natural gas, they also import oil and coal. So their backup power systems, coal, also are very heavily dependent on Russia. America also imports oil from Russia and has been disincentivizing American oil production, and we put sanctions on everything apart from Russia's main export.
So this is where geopolitics gets quite interesting. So I don't know if you read yesterday, Keith, but people are saying that an agreement with Iran on the nuclear deal is imminent, and that will, notionally put roughly 2 million barrels of oil a day into the market. Russia produces 5 million barrels of oil a day for export, presumably most of which will go to China. The Iranians have been exporting to China through the sanction, and it's in the US's interest, short-term interest, to have Iran come out of sanctions and start to be able to export its oil again. Long-term, of course, Iran is a nuclear threat. So the whole thing becomes incredibly complex, and it emphasizes the fact that for many years our energy policy has been suicidal. And it doesn't do much good to say it now, and saying "I told you so" isn't, doesn't solve the problem. But you do just wish that politicians had a bit more sense than they actually have with these things.
Well, I think the narrative might be changing now to energy security. Now, when we say we haven't instigated sanctions on Russian crude exports, well, the private sector is doing it on its own. So private entities just don't want to deal with Russia on moral grounds. So this is the differential between Russian crude and Brent. And you'll see it's trading at a huge discount because actually Russia is finding it difficult to get hold of tankers to export it. Richard?
Yeah, I think a tanker rate's gone up something like tenfold, hasn't it, for exporting Russian oil? I noticed that the British Land are saying that they are going to remove Gazprom from one of their flagship properties in London, which is Gazprom's European trading floor. And of course, at that point, Gazprom will not have a European trading floor because no one else will engage with them.
A quick break from the war, and let's go to Inflation Watch. So we had a couple of new data points this week, and they weren't good. As we've covered, European February inflation came in much higher than expected. Expectation of 5.2 came in at 5.8, and German inflation also ticked up. And when we talk about a wage price spiral, these are numbers from the Atlanta Fed, and you'll see that wages for young people are rising really strongly, and that will be mainly the service sector jobs. But then older workers have wage rises well below inflation, so there's a big dispersal between sectors. And the personal savings rate in the US has fallen back to its long-term average. Now, US consumers will still have savings, excess savings they built up during the crisis, but their current level of savings are returned to normal. And we are seeing inflation absolutely everywhere. And I thought this is quite interesting. This is salmon prices shooting up. This, sadly for everyone, our viewership, is malting barley prices. So your pint of beer is going to go up because barley prices have risen from what, that 200 to 350. And rising gas prices in Europe equals rising electricity prices, as I know from my electricity bill. But that was before the most recent spike. So if this continues, we're going to have a very serious energy shock. Last week, we talked about how supply chain difficulties seem to be easing. Well, a bit. These are container rates, and they're coming down a bit, but they're still very, very elevated. So inflationary pressures are everywhere.
So a little bit of a snapshot of some US economic activity. So there's 6 graphs. So this is the TSA checkpoint travel numbers. So this is showing the number of people flying, and the red line is showing that the 2022 activity is in between 2021 and 2019 activity, but it's rising nicely. So it looks like the number of people flying in the US is coming back to more normal times. And this is the number of people eating out in restaurant bookings. And what you can see is that In many of them, where they are above, so for example, Florida is above pre-COVID, and California is above pre-COVID. New York is rising steeply, but still below COVID. And so there's a considerable return to normal levels of activity in terms of dining out. Gross movie sales, as Keith points out, it depends on what film happens to be on as well. But the dotted line is a median from 2016 to 2019, and the red line is 2022. And you can see that there appears to be some recovery, although it's not fully recovered, but undoubtedly people are feeling more comfortable to return to cinemas and presumably theatres as well. Hotel occupancy rates, again, from the red line for 2022, pretty almost back to normal, one would say. So again, people moving around, going on holiday, business trips, and so forth. So this is a chart showing a number of searches for destinations on Apple Mapping, and again, certainly a number of searches appears to be have normalized and is back at around about or slightly above pre-COVID levels in selected cities. So there's an indication that travel, hospitality, and entertainment are reverting to normal. With the exception of people who are not going into work. So people still not using the subway. We don't know how much this has been substituted for vehicle transport, motor vehicle, private vehicles, but clearly there is a massive drop off in the number of people using the New York subway system, and it's not showing any signs of recovering. So those pictures suggest a picture of improving economic activity. Obviously, they're all pre-Russia's invasion of Ukraine and the huge spike in commodity prices.
Okay, thank you, Richard. Well, my asset allocation, as regular viewers will know, is heavily weighted towards oil, because prior to the Russian invasion of Ukraine, I thought the oil market would be already tight, and obviously invasion is only going to make that worse. Now, what happened when oil prices spiked really hard back in the 1970s? So this is a chart of inflation adjusted oil prices leading up to the Yom Kippur War, when OPEC instigated this oil export embargo. And you see that oil prices have been steady and steadily falling in real terms until there was this enormous shock and oil prices doubled. So this is nominal oil prices over the course of the 1970s. Now remember that oil markets were much less developed then. Oil mainly traded on long-term contracts, and as you can see, there was only one-way volatility. So oil prices only went up. And if you adjust for inflation, that is still largely the case. So the oil price spike had a terrible effect on equity prices, and equities had an awful decade. So this is the S&P 500 over the course of the 1970s, and you'll see it fell by half over the course of the entire decade. And in the recession induced by the oil price spike, equities halved. Now, oil companies such as Exxon actually did very well throughout that period. So in 1974, ExxonMobil announced its earnings were up 66.7%. But you can see from this chart that the oil price fell by about 45%. Now, press reports of the time concentrated on the danger of retrospective windfall taxes. Thank you to Angus A. for our Discord for finding that. Same with Chevron. Chevron shares fell about 55%. BP shares fell around 65%. Now, they were all making a great deal of money. Now, this table comes from a 1974 Senate investigation into the profitability of the major US oil companies. If we just look at Exxon at the top here, if you look at 1974 compared to 1973 or 1970, in 1974, they announced net income of 2.6 billion. And that is more than twice their 1970 earnings and was substantially up on 1973. So there was no collapse in the earnings of the big oil majors. Their earnings continued to climb. So why then did the share prices collapse? Well, the backdrop of this is there was very high inflation, and actually the US raised interest rates during the recession because of the high inflation. So that should be borne in mind in this discussion. So this is the federal funds rate. But I don't think that explains at all what happened to oil equities. I think the only thing you can say is that oil companies were not immune from the crash. And when investors pulled their money out of equity markets, they pulled it out of everything. And these companies were then quite large portion of the equity market. And if index funds sell, they sell everything. So the conclusion from that is, if it looks like there's going to be a recession, actually, you need to get out of everything. Richard, your thoughts?
Yeah, it's interesting, isn't it? I think sort of a general slow, gentle rise in the price of oil is probably very beneficial for oil companies because their profits are on a nice steady trend. Obviously, the talk of windfall taxes spooks the market, and I wouldn't be in the least bit surprised if even in the UK we end up with some sort of windfall tax on oil companies. You have to, if you look at when you're investing in a company, you're investing in the total cash flow of that business for, say, that's 20 years. And so if you look at an oil company which is earning a particular level of profitability at a particular oil price, the oil price then doubles. Yes, the profitability of that company will go up significantly, but only for the period that the price is sustained at twice as much. But the oil price is sustained at that level. But also, particularly with oil, you then move into the recession, which we just talked about, and demand drops and the oil price drops. And so the profitability of the company drops. So the danger is that under these circumstances, you think oil price has gone up, the value of the business has gone up, the oil business has gone up. And actually, it hasn't necessarily done so, because over that 20-year period, the cash flows may not change very much. So, or they may even go in the opposite direction to the one you're expecting. And I think that's the dilemma actually with investing in any resource stock. You have to understand what the impact of the price changes and the underlying commodity will be on the cash flows of the business over a prolonged period of time.
Yeah.
And that's difficult to get right, particularly now as things are so volatile.
Yes, although Richard, I really think the dominant effect is risk aversion when it comes to the crash in the prices over that period.
Yeah, I mean, I think so. If you're, I think it's very different. There is no right or wrong answer, Keith. So I think particularly if you invested in a dividend-paying oil company, and you're happy to sit with the dividends, then over a long period of time, you are likely to continue to receive the dividends, and they will continue to go up. The difficulty is trying to navigate one's way through this sort of period of a few months to let's say, 2 years.
Yeah.
So, I mean, one alternative is to invest in the commodity itself, because that's a much harder thing to do. Commodities can be very volatile, and I'm not really advocating them. Unless you're an expert in trading commodities markets, I think that's quite a dangerous thing to do. And I'm not, so I don't.
You have to understand the futures curve, whether it's in
Yes.
contango or backwardation. If you get that
Yeah.
wrong, as we saw, during the crisis, if you don't understand what you're buying, then WTI closes at -40 and you lose everything.
So a little review of what's going on in the world wheat market. Russia and Ukraine account for about a quarter of global grains, and 102 million tons. And so clearly disruption to the Russian and Ukrainian wheat supply is massive. I guess there's two questions. In Ukraine, what's going to happen to the harvest this year in the summer? The Russian harvest will probably be fine, but what will happen to their exports? And then the secondary question for Ukraine is, well, most Ukrainian grain is exported by through these three Black Sea ports. And yesterday, a Estonian cargo ship sank after it struck a mine, which I think is probably put there by the Ukrainian Navy to blockade one of its harbors from Russian warships. That means that export via the Black Sea is made very difficult, A, through the fighting around the ports, B, through the fact that ships may not be able to navigate the Black Sea safely. So there are significant supply issues. And then where does the wheat go? So Ukrainian wheat goes to these countries listed particularly down at the bottom. So quite a broad spread of countries. And Russia exports a lot of its grain to Egypt and a lot of it to Turkey. So I think looking at this, what you could say is that Ukrainian supply is under serious threat. I don't think we know yet whether Russian supply is under threat. So the loss of Ukrainian supply would have a huge impact on the food security of the countries below. And the ability of the world to substitute for a loss of Ukrainian supply has to be limited because it's so large. And that, of course, is reflected in the 1-year wheat prices. And also, we are at a significant 25-year high for wheat. And the Arab Spring, which was in 2010?
11,
thank you. Which was caused by, to a great extent, caused by food price inflation. Well, we're way above the wheat price that prevailed at that time. So we are potentially looking at some serious social unrest in countries which are dependent upon these supplies of corn and wheat. And it's going to filter through into inflation everywhere. And this is going to be a serious social problem for years to come. In my view, corn prices over 1 year at a high for or nearly at a high for the year, and over 25 years, nearly at the 25-year high. So, and that's the cargo ship that sank. So we're going to expect more disruption to the world's wheat supplies, elevated prices, and serious social unrest, and without any obvious exit path at the moment.
Okay, so quickly running through some other charts. Now, this is the path of Eurozone GDP, and you'll see that every crisis has left its mark, including COVID. And so Eurozone GDP growth has not returned to its pre-COVID path. US disposable income is falling back to its pre-COVID norms. The personal savings in trillions is still above where it was pre-COVID, but frankly not by much. So the US government's largesse seems to be largely spent now. Now, talking about the global supply chains, well, the supply chain difficulties are being caused by record global trade. So we look at the amount of trade inflows into West Coast American ports, it's at all-time highs. That's what's causing supply chain difficulties. Now, the other thing that's happening is that corporate bond yields are normalizing. They're extraordinarily low, but this is only going to get worse with the war. We're going to see risk aversion, and suddenly credit spreads are going to matter. Now, one of the amazing things that happened during COVID was the flattening of the credit spreads, so that European junk bonds actually yielded close to zero at one point. Well, risk aversion is going to cause a big widening of credit spreads once again. Now, the other thing is the Chinese property crash, insert crash there, has not gone away. So these are home sales for the biggest Chinese property developers. These are frightening numbers for the solvency of Chinese property developers. So current global events are not going to be good for the Chinese financial system either.
No, I think, yeah, I mean, China has got, as you say here, Keith, China has still got this property problem. It isn't going to go away for a number of years. And it is going to have to spend a lot of money shoring up its property developers so that it doesn't suffer huge damage to its economy. I mean, the other problem that China's got is COVID in Hong Kong, which I think is seriously damaging from a reputational point of view, and seriously damaging to Hong Kong as a place to do business, and which calls into question the vulnerability of China as a whole to COVID, because I don't really understand what's different between Hong Kong and China.
Good point. Okay,
so as Keith says, it's been a shockingly bad week for equity markets. FTSE All Share down 5.6%, nearly all of the entire move for the year. The stocks Europe 600 down 6% and 11% on the year. The S&P 500 and Nasdaq actually pretty much getting away with it, but significantly down on the year. Japanese market down 4.1% on the week, which is a lot given their apparent insulation from Europe geographically. Bitcoin up 2.6% on the week, and possibly a reflection of some sort of safe haven bid, but I don't know. The pound down against the dollar by 2%, and the dollar index up by 2%. The flight to safety in the US dollar, I think, is apparent there.
Now, I thought this is really interesting. This is the SPACs. So the blue line is their projections for what their revenues would be in 2021 in their IPO or original company projections, and the black line is what actually happened. And then none of them are even remotely close. In fact, several of them had no revenues at all. And this is a game as old as time. This is why investing in early stage growth companies is a very dangerous thing to do, essentially.
This is a shell game, isn't it, Keith, basically?
Yeah.
It's been remarkably profitable for the sponsors of these companies, and remarkably unprofitable for the investors.
Yeah. One of the beneficiaries of the crisis will be defense companies. Now, these are the shares of Rheinmetall, which is a German defense company, and you will be aware that Germany has now decided to raise its defense budget to 2% of GDP, which will involve big new spending. In fact, all the Western countries are giving Ukraine loads of anti-tank missiles and surface-to-air missiles, which they're going to have to replace. So expect a surge in defense spending everywhere.
Yeah.
And this is last week. And obviously this is already out of date, but you'll see that last week there were huge falls in the vast majority of sectors, and the only one to eke out a tiny profit was energy. And this is the share price and revenues of Zoom. And you'll see that revenues have grown, but growth has failed to continue, particularly with the end of COVID. And the share price has absolutely collapsed. And this is sadly the classic trajectory for most growth companies. They do well on optimism when they're growing quickly, but the market then extrapolates that growth into infinity, forgetting that growth always slows. And as growth slows, share price collapses. And I thought this was fun. So this is the market capitalizations of electric vehicles companies, that's in the green, and traditional internal combustion engine manufacturers in purple. And you'll see that electric vehicle manufacturers have twice the market cap of the other lot, despite having a fraction of the sales. Okay, and on to energy commodities, and it's been a really shocking week. So this is what I am watching. This is very important for the world economy. So during the week, crude oil, WTI, was up 15%. European natural gas futures were up 45%. They're up 128% on the year. That's 2 months. Coal was up 54% on the week, up 118% year to date. Uranium, bear in mind Russia is a big supplier of uranium, was up 15%, up 18% year to date. So energy is getting much more expensive for everyone. If we go into the data that matters for the oil market, we're going through some numbers important to the oil market. Well, last week, US crude inventories continued to fall. So all indications the market was tight even before the impact of the war in Ukraine. In addition, US oil production failed to grow again last week and is still 200,000 barrels a day below its production at the start of the year. So US oil production is not growing currently. And the Baker Hughes rig count ticked up by 2. So this is who Russia exports their oil to. Now you can see the biggest customer is China, but also exports to the rest of the world, and a lot of Western countries are now stepping back and attempting to avoid using Russian crude.
So the interesting thing here, Keith, is that sort of, I know technically there are different crudes and refineries built to operate off different mixes and so forth, but in essence, oil production is to some extent fungible, isn't it? So they may cease exporting it to European countries, but China will take more and it will take less from elsewhere. And so the total export is unchanged. It's just that the source, the destination of the exports changes. So the question I have, and I don't have an answer to this, is to what extent will exports of Russian crude actually fall?
Well, on the exports to China, Richard, a lot of it depends on infrastructure. So if the pipelines to China are full, actually, it becomes really quite difficult to export more to China.
And of course, as we discussed earlier, the price of shipping has gone up hugely. So that puts, it doesn't stop it, but it reduces the Well, I don't know what is the effect of that. Does it even encourage it? Because shipping companies will make more money out of it.
Well, the thing is, a lot of Western shipping companies will attempt to avoid Russia simply because of the reputational damage. And
Yeah.
also, in the 1970s, there was a whole industry of the commodity trading houses who made vast amounts of money by essentially skirting Western sanctions. So they made huge amounts by exporting Iranian oil, which Iran was then under sanctions, to South Africa, which was then under sanctions. But they have all become listed companies, and monitoring has got better, and the fleet of grey or black tankers is now much smaller than it was in the 1970s. So I think that it's going to be more difficult to skirt sanctions if sanctions on Russia come in. But right now, the private sector is essentially exerting its own sanctions. So there will undoubtedly be a reduction in Russian exports. We just don't know by how much. So this is the crude oil chart. This is WTI, and that's daily data. Now, if we look at hourly data, you'll see that yesterday, crude almost hit $120 a barrel. And at that stage, I was getting extremely concerned that that would tip the world economy into recession in short order. Now, when we look at oil suppliers around the world, Venezuela had been coming back. So Venezuela, you'll be aware, exports very heavy oil, and they had received a cargo of diluent from Iran, which allowed them to dilute the heavy oil, get it to flow better so they could extract more, and their exports had grown, had recovered. Well, that was a temporary effect. It's falling back again. And that is not good for world oil supplies. And you'll also be aware that there is disruption in Libya, and one of the Libyan fields, I believe 400,000 barrels a day, is now offline. So when you have tight oil markets, the regular flow of adverse geopolitical news becomes actually very important. And this is tanker earnings, Black Sea. So how much they're willing to pay to get a tanker to export Russian oil. Essentially, a lot of Western companies are just not doing it. Therefore, the few available can charge whatever rate they like. And what we have been talking about relentlessly since we have been doing this podcast is that there's a very high correlation between oil price spikes and recessions. And during the week, I was very concerned that the recent spike in oil prices would induce a recession in short order. And it is my concern for the year. I think if oil prices stabilize at around these levels, the world economy can probably live with them. But if the oil price rises above 130, we need to start getting out.
I think the interesting thing about this graph, Keith, is that it's the oil price has been adjusted for inflation, so it's a real oil price. So you get a very clear idea of the point at which the inflation-adjusted price starts to cause a recession, and we are bang on it now, an inflation-adjusted price of $50. My view actually is that the oil price is going to head up towards $200 a barrel before it stabilizes. I have no sound analytical basis on which to say that, but I think the situation is pretty extreme. Yeah. I wouldn't be surprised to see that happen. Whether that's reflected in the prices of shares and oil company shares, I don't know. But clearly, if I'm at all right, then almost inevitably the West is going to go into recession.
One of the key things we're going to be watching going forward this year is the oil price. The oil price goes too high, we think there's a big danger of recession, and you need to adjust your asset allocation hard. Presented without comment. So this is Dutch natural gas futures as of this morning, and they're spiking right up back towards their highs. And that is going to affect the price of power and electricity and the price of everything that is dependent on gas, particularly fertilizers. And that will affect food prices. And we have been buying more Russian gas. So Russia has upped its supplies. And these are countries most affected by Russian gas exports. So it largely exports to Germany, Italy, Netherlands a bit. And then the further away from Russia you get, the less dependent on Russian gas you are. So the UK, Spain, and Portugal are hardly affected.
I read the other day, looking at that map, actually, Keith, that Finland has determined to extend the life of one of its nuclear power stations by 20 years. It was due to close it down.
And there is a big danger that all these gas pipelines that run through Ukraine could be disrupted by military activity, accidents, bombs. So it could get much worse. And this flows through Nord Stream 2, which are running at full capacity as we fund Putin's war effort. Coal, gone through the roof. Uranium, spiking. None of this is reassuring. Okay, Richard, industrials.
Yeah, so basically a week of significant price rises for most industrial commodities. 10%, looking down this table, 10% is the norm. Cobalt was unusual in that regard, as was chromium, which seems to be taking a pause. Magnesium, quite surprisingly, actually, down 4%. And as we've discussed, magnesium is highly dependent upon large quantities of electricity, and a lot of it is produced in Russia. Nevertheless, the price of magnesium has dropped, and has dropped significantly since the start of the year. Neodymium, again, has dropped. The thesis, has to be that more energy, more money, more effort will be put into producing more wind farms and more solar power more quickly than was previously planned to try and wean Europe, particularly off Russian gas. So although this is just a short-term take, neodymium is up 32% on the year, which isn't very far in, 9 weeks. It is down nearly 3% on the week, which sort of is slightly flies in the face of their thesis of more requirement for rare earth metals for greening the energy supply of the planet. So aluminium, cobalt, copper. I would just say on copper that if you are a chartist, you would say it's just broken out of its flag pattern, and that would suggest that it is in for a large rise. Chromium, iron ore, lithium,
unbelievable,
magnesium, neodymium. Basically, it hasn't stopped its uptrend. It's just having a slight pause for breath. Nickel and tin, ferrovanadium,
climbing.
Precious metals. So precious metals had a decent week. Gold up 1%, silver up 3%, platinum nearly 2%, rhodium unchanged. And palladium had a good week. I think around about 45% of palladium production comes from Russia. So obviously users of palladium are going to be struggling for that resource. So what I would say about gold and silver is that you would think that they would have reacted more than they have to the events in Ukraine. And my view is that this isn't a universally accepted view, but there is a fairly effective price suppression scheme in operation for gold and silver, and partly it's operated through the ETFs actually not possessing gold, physical gold, but possessing contracts with counterparties that say they can have the gold if they want it. So the people who buy the gold and silver ETFs aren't actually buying the metal, and that is a mechanism which is used to control the price of gold and silver. And there's a reason that it needs to be controlled, in inverted commas, which is to do with the security of the dollar as the world's reserve currency. And obviously, if gold appears to be circumventing or becoming more stable and more valuable than the US dollar, that helps to undermine the US dollar reserve currency. So I state that as in my view, a fact. Obviously, you could take issue with that if you wish to. But notwithstanding that, if you look at where, and we've had a long discussion today about what can you invest in, what does give you investment safety. And at the moment, those decisions are difficult. And I think in the future, they're going to become increasingly difficult because we have a vast amount of uncertainty in the world, which doesn't show signs of ending soon. So to my mind, that means that every sensible investor, be they an institution or a private investor, should have an allocation to gold. If that occurs, and I suspect it is actually occurring, then the price of gold, despite methods and actions to try and suppress price rises, the price of gold will continue to rise, and that is the thesis on which I'm operating. And the action in the gold and silver market, to my mind, bears out my thesis. Keith, what are your thoughts?
What I really like about gold is liquidity. And the thing is, Richard, I have no concerns about the ETF. And I traded the iShares physical gold ETF, and I was astonished by the liquidity and the bid offer spread. So when I had a big allocation to gold, you could put through very large allocation changes with no impact at a cost of which was measured in basis points. So as a safe haven, I really like it because you can get in and get out very quickly with no impact.
So I think that is true, Keith. But I would say that given that the ETF is supposed to have allocated gold, how does it manage to get and or sell these large quantities of gold on a daily basis, or even a weekly or a monthly basis? And that's, it doesn't have it. So the danger, to my mind, is that if you want gold as a hedge against some form of serious financial event, your hedge doesn't actually own the physical asset that is the hedge, and therefore your hedge disappears. It's not a hedge anymore. Well, that is the problem, to my mind.
Okay, but I think in order for that to be revealed, so that there is the link between the ETF and gold breaks down, you'd have to have a systemic financial crisis, and I think that is very unlikely. Fingers crossed. And I'd also say, Richard, that as somebody has looked into buying physical gold, well, buying physical gold, there's a very significant bid offer spread, and also, if you were to buy it in any size, you then have to store it, which costs you 1% a year. So,
I agree, Keith, and it's not easy. And then, there's a serious financial crisis, and you walk into a shop with a gold bar, and it is not. It's not really a practical proposition, and it's all so. But what for me, these events in Ukraine are sort of calling into question some of the principles on which we have for the last 70 years and beyond our lifetimes, therefore, lived by. And in some senses, you do wonder if we're moving back into the world our parents and many people's grandparents occupied during the Second World War.
Yeah.
Now, I don't wish to be too fatalistic about it, but I suspect that things are changing and that things are going to be significantly less comfortable for a lot of us than they have been over the last few decades.
Well, currently what's going on is the revenge of the old economy. Everyone's dismissive of oil and gas. Well, I'm afraid it really matters.
Yeah. Gold, silver, platinum, rhodium, and palladium on a bit of a tear.
Yeah. Now, a reminder, palladium is almost entirely used in auto catalysts. So if you look at the chart top left, the vast majority of it is used in catalysts. Okay, on to rates. And so we have had a bout of risk aversion and flight to safety, and people have been buying government bonds. So UK bond yields fell across the curve, particularly at the short end, as people have started to reduce the probability that there will be near-term rate rises. The fall in bond yields even extended to the periphery of the Eurozone, where both Greek, Italian, and Spanish bond yields all fell, although they remain up on the year. So this is the UK 10-year. This is the US 10-year. And let's hope that the seasonality chart is correct, but I think it's going to be upended by the war in Ukraine.
All bets are off, I think, aren't they, Keith?
Sadly, yes. What have you been up to this week, Richard?
Thank you, Keith. So this week, despite the tumultuous week in the market, personally, I had a quiet week, no purchases and no sales. I was up 0.5%, so I was slightly up on the week, which puts you up 3.1% for the year. Relative performance of 9%. So my relative performance, I think, whilst the precious metals, as we just discussed, didn't respond as you might have expected them to, neither did they sell off. And so the mining, I think the precious metal mining shares that I have are doing moderately well. So I had some losses in my portfolio, one of which I'm going to talk about in a moment. But the significant weighting towards precious metals in my portfolio kept me basically pretty much neutral on the week, which I suppose is doing its defensive job. So the one I want to talk about is ferroalloy resources, which I purchased around about mid-March 2021, and so benefited from the very, very steep rise, and have since been watching this share with huge volatility. And for those who don't remember, it produces ferrovanadium in Kazakhstan. And so recently, as in the last few days, it has been subject to considerable price pressure on the basis that it's in Kazakhstan and is it vulnerable question. And the company came out with a statement on Thursday, I think, saying that operations were continuing as usual and they weren't experiencing any difficulties. Clearly, it's in a regionally unstable place. But notwithstanding that, I've decided to retain my holding. Time will tell, but it's a significant size holding, and my portfolio got knocked a little bit by that. But this is an investment for the long term, and I suspect personally that Putin's adventurism will stop with Ukraine, and he won't have the resources to take it any further. If I'm wrong, then I'm wrong. And that was it, really. I am positioned My portfolio is pretty defensive, and I am positioned in a way that I hope will protect me from the vicissitudes of the global markets and global geopolitics. And fingers crossed. And the last thing I'd like to say, Keith, is personally how very, very sorry I am for what's happening to the Ukrainian people. And I'm sure, like many, if not all of our listeners, I shall be making a donation to a humanitarian organization, probably the DEC, to show my personal support for the Ukrainian people.
Yes, on that note, actually, I have made a donation to the International Red Cross Appeal for Ukraine. And I believe all that money goes to the Ukrainian Red Cross.
Well done.
Thank you, Richard. Well, I, like Richard, had an okay week, but I tell you, my week was amazingly volatile. So I was up 4% a couple of days ago as the oil price rose. And despite the rise in the oil price over the week, in the last couple of days, oil equities have had a big sell-off, and that has taken away all my profits earlier in the week. And I ended the week as of 8:30 this morning, up about 0.4%. With year to date, I'm up 5.9%. So surviving, but very worried. Now, I did some selling this week, and I sold all my UK banks because as we discussed earlier, there's going to be a lot of financial stress around, and I don't want to be geared. Banks are basically geared to the economy. I don't want to be geared to the financial system or the economy. So I sold them all, sadly, at quite much lower than their peak, but, with a profit. And I bought Rolls-Royce, whose shares price have come off very heavily. Now, 50% of their earnings come from defense. So I think that actually they should be all right, although so far that hasn't proved to be a good investment because the share price has fallen. I also bought some BHP Billiton. Now, BHP Billiton actually will be spinning off Woodside, which is their natural gas arm, in July, and will be giving shareholders shares. So I reinvested a decent portion of my financial sales into BHP, and then I bought some small oil producers. I also added to Rambler, which came out with a decent statement, and the copper price is rising, and I hope it's going to be a good year for them. Also, further to Richard's statement, I bought some ferroalloy resources because the share price absolutely collapsed after they'd come out with this emollient statement saying that their activities were unaffected, and actually the fall in the Kazakh tenge will cut their costs. So actually it's quite good for them. Now, the one company I wanted to talk about was a company we've covered in Share Talk, which is i3 Energy. Now, although all their revenues come from their Canadian assets, actually most of their reserves are in the North Sea, and they have been talking about trying to farm out their light oil field Serenity for years now. So this week they announced the farm out, and frankly, I was pretty shocked by the terms. So bear in mind that i3 now have very significant earnings from Canada, but they sold a quarter of the Serenity field for essentially 3.5 million quid. So Europa, who's the farmee, will receive 25% of the Serenity field for funding 46.25% of the appraisal well. And the appraisal well will cost 14 million. So in effect, they're getting 25% of the field for funding the extra, what is that, 23.25% of the appraisal well that would normally be funded by I3, and that is going to cost what, 3.5 million. So yes, I3 have managed to offset some of their costs and risks, but they've given away 25 for this 25% of this field for an absolute song. Anyway, so that is rather depressing when you think about, for example, Orcadian Energy, which is attempting to find a farm out partner for its heavy oil assets in the North Sea. What terms can it hope to get? This tells me that farming out is really tough, essentially. You don't get very good terms. And it's been a very long one this week. Thank you all for sticking with it to the end. It's been a very depressing week in the markets. And frankly, we've been doing this for 2 hours. And when I go and look at the equity markets, I worry what I'm going to find. In the meantime, please, can you press like and subscribe to the channel? Good luck, everyone. It's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.